Hey guys, Serge Berger here. I'm going to show you guys an amazing view here in just a second. Wanted to just take a couple minutes and look at the stock market together, because one of the things that we've been talking about here and to our clients, of course, for the past 3-4 months at this point, is that yes, the broad stock market and the economic signals don't look very good. However, if you look at the technicals and you respect the price action, you have to respect what we're seeing. So let me flip to the charts, and then I'm going to show you guys a cool view. So here is a very simple chart, and I know there's some glare of the sunlight back here, but this is the New York Stock Exchange Composite. NYA is the ticker symbol, and we've highlighted this one here a couple times in these videos, and of course with our direct clients all the time. And you can see what we consider sort of an inverse head and shoulders pattern. This is purely technical, and the longer we sort of consolidate up here, the better the odds are that we ultimately break to the upside. And this is kind of exactly what's happening around. It doesn't mean we can't retrace lower, but the more we sort of stagnate here and sort of coil and consolidate, the more constructive all of that is. Now we can look at the XLF. This is financial stocks representing the S&P 500 financial stocks. You can see or the sector of the S&P 500 financials. Here too, we are consolidating. We've actually already broken past some resistance. You can look at European stocks, for example. And this is really important to watch, because global risk takers are still going towards looking to allocate towards risk assets, evidently so. This is the Euro Stoxx 50, and I'm going to try to zoom in a little bit more. Give me one more second, just to give you guys the context of how important this potential, Jesus, I have to go back a long time in this one, this potential breakout here is in this. And you can see, kind of how this is, again, the longer we coil down here, which is, again, just like the New York Stock Exchange is looking more or less, I mean, it's a little bit different of a pattern, but it looks very similar in nature. So if you take all this together, then you have to respect the price action. And again, this is not to say that we're going to break into a major new bull market, but for example, there's a guy I used to work with. He had all these indicators, and he was an okay trader, but he left a lot of money on the table because he basically used his indicators too much. Because what he forgot to understand is that the ultimate arbiter is always going to be price action. So I'm still respecting our models, and I still think economic growth is slowing, and there is definitely a lot of downside potential. But if you respect the price action right now, I think it's very difficult to open up fresh short positions in broader equity indices and other risk assets like high yield at this point, until you have some price action to kind of do the opposite. Now, I'm going to show you guys a really cool view. I'm on a little vacation here today in Italy, and here's that. Isn't that beautiful? Isn't that beautiful? Look at that. It's so peaceful here. We have a lot of good food and wine. Families down here somewhere by the pool. Where are they? Down there somewhere. With that, talk to you guys soon.